in. Now, we have Professor Anwar Nasution, who was the senior deputy, the number 2 in the Indonesian Central Bank. That was immediately after the transition, and Professor Anwar will share with us his insight of the Indonesian experience.
Thank you very much. Before I start, let me thank you, Wing Tai Wu and Kir, for inviting me to this important event. My name is Anwar, and the other Anwar is my old friend from the student days, yeah? Anwar Ibrahim. I think you are lucky in Malaysia, you have a leader like him, and then supported by good economists. This Wing Tai Wu, he has been my co-author for how many decades? 1986, yeah? So I think that, again, you are lucky to have these 2 gentlemen, maybe to assist you in the transition period. My presentation is focusing on Indonesia. As you are aware, that in contrast to Malaysia, we signed the IMF program in 1997, and it lasted to 2003. The IMF program eliminates the previous state-controlled economic management under the administration of President Suharto, and then we moved to market base. I understand from Wing Tai Wu presentation, you in Malaysia are still in state control. Yeah? Not much different from China. Yeah? The state control during Suharto era cover all segments of the economy, such as the banking system, trade system, licensing, state procurement, and efficient state-owned enterprise. Yeah? And all of this has been the source of corruption. KKN, we call it in Indonesia, corruption, collusion, and nepotism. In theory, President Suharto said you have to equalize the distribution of wealth, in theory, yeah? But in reality, totally different. You see that from the bad loan under IBRA, Indonesian Banking Restructuring Agency, that took over all the debt loan of the Indonesian bank during the crisis. There are 2 components of the IMF program, namely short-run stabilization policies, and the other one, medium and long-term structural reform to raise productivity. Next. The short-run stabilization policy, there are 2 main components. One is monetary policy, and the other one is fiscal policy. On monetary policy, Bank Indonesia, the central bank, has shifted its fixed exchange rate management to independent floating, like in Malaysia before the crisis. Yeah, we have fixed exchange rate, so it creates incentive for bank, private sector to borrow overseas. Yeah, to build non-trade sector economy. What are they? Housing, malls, golf courses. Yeah, using this foreign money in foreign exchange, and then most of them are in short term. Now we abandon that, and then we replace that with soft inflation targeting, similar to Malaysia. I think Bank Negara Malaysia also use this inflation targeting now in Malaysia, and in the case of Indonesia, supported by fiscal discipline. Next. Under the present system, Bank Indonesia uses interest rate as the opening the target of its monetary policy, exactly similar to Malaysia. Yeah? Bank Negara Malaysia also used this interest rate as operating target of its monetary policy. Its lower interest rate to stimulate the economy and raises it to dampen economic growth, control inflation. The market-based monetary policy required a financially healthy banking system and deep and well-developed money market and capital market. We don't have that in Indonesia. I think in Malaysia also your money and capital market is not well developed. It's not well developed. Next. To rebuild the financially ailing domestic banks, the government of Indonesia at the time injected a large amount of rupiah-denominated bonds in 1998, similar to Malaysia. In terms of GDP, the cost of bank restructuring in Indonesia is the highest in the world, all the way from Adam until your generation, amounted to 50% of GDP. Yeah, it's very expensive. This is what we, the cost of bank restructurization in the past. Indonesia has no strong domestic institutional investor, such as pension fund, insurance company, and postal saving, to absorb the sovereign bond. Japanese also have no well-developed money and capital market, but they have very strong postal saving. Yeah? They can mobilize saving very cheaply from the masses and then use the money to absorb government bonds and to finance this infrastructure project. Indonesia, we don't have that. We had that during colonial days, but it was destroyed during the high inflation and civil war before Suharto administration. At present, short-term capital inflow control about 1/3 of domestic bonds and equity market to provide liquidity. This is very dangerous. Next. Why is that? Because the bond and equity market are quite volatile, as the role of foreign investor is they are the provider of liquidity in the market. The price of bond and equity rises when there is short-term capital inflow that reduces domestic interest rate and further contribute to boom, expansion in the credit. The central bank sterilizes the capital inflow to stabilize external value of domestic currency and accumulate international reserve. Yeah. Next. Capital outflow depresses prices of bonds and equity, raises burden of the issuer, and creates losses for financial institutions with large holding of the instrument. You have this experience in 1997. That's why you introduced capital control. Yeah, this is the main reason why you introduced capital control, because of this. Because Singaporean and then also capital inflow withdraw their money from Malaysia, drive up interest rate, and also the ringgit, external value of the ringgit, that could produce better result for banks and corporate sector. This is the instability of the price of sovereign bond distort its role as benchmark rate for corporate borrowing. Next. In reality, the budget deficit in Indonesia has been maintained to 1.5 to 2% of annual GDP, and public debt to GDP ratio is below 30%. At present, it's only 27%. In my judgment, this policy is good for image building, to raise international rating by Standard & Poor's and other rating companies. But the policy is bad for economic growth because no financial resources to build the badly needed infrastructure. How can we compete with Malaysia if there is no electricity? How can we compete with Malaysia if there is no road, no harbor? Yeah. So this is very, very important. At present, about 20% of government expenditure goes to subsidies of oil and electricity. Who got benefit from this policy? The rich people who drive a big car. And then also people like us who enjoy this aircon. Yeah? And then also Indonesia, they smuggle the subsidized oil to neighboring country. Yeah? So this is the problem. Then structural reform. Indonesia has introduced a wide range of structural reforms since 1997. Financial sector, trade and investment policies, and state-owned enterprises. However, if we look at the picture, external trade to GDP ratio, FDI to GDP ratio of Indonesia remain the lowest in ASEAN 5, much lower than in Malaysia. Yeah? The investment climate is still unattractive. Unlike Malaysia, Indonesia is not in the global supply chain. Penang, I think they produce that parts and component of electronics, yeah, and then also automotive. Not in the case of Indonesia. Public institutions remain very big. In the case of Indonesia, as shown by high transaction costs, market failure, as well as public sector failure. What is the sign of public sector failure? Our state-owned enterprise cannot compete with state-owned enterprise owned by Singaporean. Our Garuda cannot compete with Singapore Airlines, yeah? Things like that. Currently, there is a tendency of going back to protectionism in Indonesia that will maintain Indonesia as a supplier of raw materials and cheap labor to Malaysia. Now you import the palm oil from Sumatra to Malaysia, you process it here to produce a high quality product using Indonesian labor. Yeah? So I think I stop here, Mr. Chairman.